Welcome back to the Deep Dive. Today we're plunging into BofA Securities' latest research report on Xiaomi Corporation, hot off the presses from July 8, 2025. The big headline here: BofA has not only reiterated its BUY rating, but also significantly lifted its price objective for Xiaomi to HK $69.
Exactly. And this deep dive into the BofA report gives us a fascinating updated look at Xiaomi's two powerful growth engines. You've got their rapidly expanding electric vehicle segment and, crucially, their robust, established core business.
Right.
We'll unearth the precise data points that underpin this optimistic outlook, paying close attention to the company's, well, frankly, surprising financial health and its rapid-fire advancements in the highly competitive EV market. For investors operating on Wall Street, understanding these nuances is critical.
All right, let's unpack this with surgical precision.
Sure.
What exactly is fueling BofA's heightened confidence in Xiaomi, pushing that price target upwards? Is it purely the EV story, or is there more to it?
Well, what's really fueling BofA's upgraded outlook are these significant upward revisions to Xiaomi's earnings estimates. They've lifted their adjusted earnings estimates for 2025 through 2027 by a notable 7% to 16%.
7 to 16%, okay.
Yeah, this isn't just a minor tweak. It's a direct consequence of higher projected EV shipments and a stronger than expected earnings performance across both Xiaomi's longstanding core business and their exciting new EV ventures. It's a dual engine lift, not just, a single cylinder one.
Okay, speaking of EV shipments, the report details a pretty substantial increase in those forecasts. Can you walk us through those new ambitious numbers?
Absolutely. BofA has dramatically raised its EV shipment estimates. For 2025, they're now projecting 409,000 units, up from 370,000 previously.
Hmm.
For 2026, it jumps to 700,000 from 620,000. And looking out to 2027, they expect a massive 950,000 units. That's a significant leap from the previous 800,000.
950,000, wow.
It is. And what's fascinating here is that the report also suggests Xiaomi is already developing a third EV model expected to debut in 2026. This lines up perfectly with their stated strategy of launching one new model per year. That's a rapid, almost unheard of pace in the auto world.
Those are incredibly aggressive targets for, well, a relative newcomer in the EV space. From your perspective, what tangible demand signals are supporting such ambitious forecasts? Is BofA being overly optimistic here, or are they truly seeing something unprecedented in Xiaomi's execution?
Well, the report describes demand as nothing short of overwhelming. Consider this. The YU7 model saw 240,000 locked-in orders in just 18 hours.
18 hours, incredible.
Right. That pushes them significantly towards their 300,000 unit per year phase 2 capacity. And the SU7, their first model, still has a 6-month delivery backlog.
6 months still.
Still. This isn't just strong demand. It's, I think, a testament to the brand's appeal. And frankly, it strongly implies that a third factory is likely already in progress, or at least in advanced planning stages, to handle this upbeat sales momentum. For a company just entering the auto sector, this order book is exceptionally powerful. It suggests they are, effectively navigating those initial production hurdles.
That context certainly makes the demand sound even more compelling. Now let's talk valuation. How exactly does BofA arrive at that HK $69 price objective using the sum of the parts, or SOTP, valuation method?
Okay, so the HK $69 price objective is meticulously derived from two distinct components. You have the core business, smartphones, IoT, internet services that contributes HK $34 per share.
Okay.
This is valued at 22 times its projected 2026 earnings per share. And notably, this valuation for the core business, it remains unchanged.
Unchanged, got it.
The significant uplift comes from the EV business. That contributes a substantial HK $35 per share. This is based on 4 times its projected sales from the second half of 2026 through the first half of 2027. That period is crucial because it captures the expected ramp-up of new models and production.
Okay, but it's interesting that BofA actually lowered the price sales multiple for the EV business from 5x down to 4x, despite this increased optimism on shipments and the overall bullish stance. That seems a bit counterintuitive. Why the adjustment, and what does it tell us about BofA's view of market expectations going forward?
It's a critical nuance, you're right, and the report is quite clear on this. The adjustment isn't really a sign of reduced confidence, but rather a market recalibration. BofA explains that the previous high expectations surrounding the YU7 launch and Xiaomi's entry into EVs, well, they've largely been priced in already, particularly after Xiaomi's stock saw that, more than 10% rally since June. So lowering the PS multiple is about normalizing the valuation after that initial surge of excitement.
Right, makes sense.
They even ran a sanity check using a 45x PE for the EV business, which yielded a very similar SOTP valuation of HK $67 per share. It tells us they're valuing future growth a bit more conservatively now that the immediate market reaction has played out. They're focusing on sustainable execution rather than just the initial promise.
Okay, here's where it gets really compelling for the investor trying to dissect the nuances of market competition. How does Xiaomi's financial health, especially its balance sheet, truly stack up against its key competitors, particularly in the notoriously capital-intensive auto and EV space? This is often where even promising companies stumble.
This is where Xiaomi truly shines and perhaps plays a different game altogether. They demonstrate superior financial strength, almost uncharacteristic for a new entrant. Their EV business, for one, is showing rapid gross margin expansion. In the first quarter of 2025, Xiaomi reported the highest gross margin on its auto business among key peers. It hit 23%.
23% compared to...
Compared to their competitors, 10–20%. And BofA doesn't see this as a fluke either. They expect Xiaomi's EV gross margin to further expand to 26% in 2026 and a remarkable 27% in 2027.
27%.
Driven by rising scale and efficiency, they believe. Critically, the report projects Xiaomi's EV business to turn a small profit from the second half of 2025.
Profitability that quickly.
Yes. That's a significant milestone, especially when you consider many pure-play EV companies are still deep in the red.
Definitely. And beyond those impressive margins, what about the fundamentals like working capital and debt? Those could be massive headaches in this industry.
This is truly a distinguishing factor. Xiaomi's working capital reached a record high of US $11.9 billion in Q1 2025. That makes it the highest among its Chinese peers.
11.9 billion. Wow.
In stark contrast, companies like BYD, NIO, Zeekr, Series, they've recorded negative working capital, often relying heavily on high account payables, essentially using supplier money to finance their operations.
Which highlights a huge operational difference.
Precisely. While many Chinese auto OEMs pledged back in early June to pay component suppliers within 60 days, Xiaomi is expected to face far less pressure from this shorter payment cycle.
Why is that?
Because of its already lower account payable days and, as we just mentioned, that exceptionally strong working capital position. Furthermore, Xiaomi has maintained a remarkably low debt ratio below 10% over the past 3 years.
Below 10%?
Yeah, compare this to peers like NIO and XPeng, who show higher debt ratios ranging from 12% up to 19%. This financial prudence provides Xiaomi with, well, unparalleled flexibility and resilience in a market that just devours capital. It's a strategic weapon, really.
So if we pull back and look at this strong performance and financial position, what does it truly mean for Xiaomi's valuation within the broader EV market context? How is BofA justifying that 45x PE sanity check for the EV business, for instance?
Right, that 45x PE sanity check for the EV business, spanning the second half of 26 to the first half of 27, it's justified by several compelling factors. Compared to other EV peers, whose PE ratios range from a more modest 15x to maybe 42x if you put Tesla's outlier 98x aside, Xiaomi's multiple reflects its stronger than peers' EV expansion trajectory, that rapid margin improvement we just discussed, and its aggressive strategic investments in advanced technologies. We're talking AI, ADS, and even in-house chipsets. These aren't just buzzwords. BofA sees these investments as crucial long-term synergies that will enhance not just the EV business, but potentially their entire ecosystem. It's a bet on future tech leadership.
Understood. So can you summarize the overall trajectory for Xiaomi's financial estimates based on BofA's revised outlook? What's the core narrative those numbers are telling us?
Absolutely. The narrative is one of robust, across-the-board improvement. For 2025 through 2027, BofA has lifted all key estimates. Total sales are projected to grow significantly, gross profit is expected to expand dramatically, and operating income, pre-tax income, adjusted net income, they all show strong upward revisions.
So it's not just EVs driving this.
No, exactly. It isn't just about the EV segment alone. It reflects an improving outlook across Xiaomi's entire business, driven both by its established core strengths and, of course, that surging EV segment. It's an integrated and, importantly, an accelerating growth story.
So tying it all together then, what's the core actionable insight for you, the investor, looking at Xiaomi right now based on this BofA report?
I think the core insight is that Xiaomi's unique triathlon business model, encompassing hardware sales, e-commerce, new retail, and internet services, all amplified by the visionary influence of founder Lei Jun. It provides a truly distinct ecosystem. The reiterated BUI rating fundamentally rests on this multifaceted strength. The upbeat EV delivery forecasts and strong gross margins, sure, but also solid IoT expansion and consistently improving internet services. It's less about a single silver bullet and more about a deeply integrated growth story that positions them uniquely in the market.
Okay, let's pivot slightly to some deeper questions this report raises. Given those incredibly aggressive EV shipment forecasts and the ambitious factory expansion plans, what are the primary execution risks Xiaomi faces in scaling its EV production while trying to maintain both quality and margin, especially as it races towards nearly 1 million units by 2027? That's just an incredible leap.
You've absolutely hit on a critical point. While the report highlights, overwhelming demand and impressive initial orders, scaling production to 950,000 units by 2027 is, well, it's an incredibly ambitious undertaking, even for a company with Xiaomi's known operational prowess.
Right.
Potential risks are substantial. Think unforeseen supply chain bottlenecks for critical components. We've all seen how fragile these can be globally. Then there's the challenge of rapidly recruiting and training a skilled workforce to operate those new factories while simultaneously maintaining stringent quality control across expanded operations. That's tough.
And the margins.
And the margins, exactly. A big question is whether those projected gross margins of 26–27% can truly be sustained if raw material costs fluctuate wildly, or if competitive pricing pressures from established auto giants intensify, which they likely will. The speed and cost efficiency of achieving profitability in the EV segment, particularly that forecast for a small profit from the second half of 2025, that will be the crucial indicator for investors. Any slip there could signal significant challenges ahead.
That makes sense. Now, the report really emphasizes Xiaomi's robust balance sheet and that remarkably low debt ratio. How strategically significant is this financial resilience in the context of the intensely competitive and, let's face it, capital-intensive EV market, especially when many of their peers are operating with negative working capital? It seems like they're playing a different financial game.
It's not just significant, I'd argue it's a profound strategic advantage. Xiaomi's robust balance sheet, particularly that record-high US $11.9 billion in working capital in Q1 25, provides them with a flexibility that many competitors simply don't possess. In an industry where, as you said, numerous Chinese auto OEMs are essentially operating with negative cash conversion cycles, relying heavily on significant account payables.
Using supplier credit, basically.
Exactly, using supplier credit to fund operations. Xiaomi's financial health liberates them from that. This reduces pressure from any tighter payment terms with suppliers, which is a real possibility. It also enables sustained, significant investment in high-growth, high-cost areas like R&D for AI, ADS, and those in-house chipsets without incurring heavy debt. And it acts as a massive buffer against unexpected market downturns or sudden investment needs. This financial stability suggests a more sustainable and potentially less volatile growth trajectory compared to some of its more leveraged competitors. It lets them focus on innovation and scale, not just scrambling for cash.
Right, a real cushion. Finally, let's just revisit that decision by BofA to lower the EV price sales multiple despite simultaneously raising shipment estimates, citing the stock rally since June. How should investors interpret this adjustment? What does it tell us about the broader market expectations for Xiaomi's EV growth going forward? Is that initial new entrant premium starting to wear off, perhaps?
I think this adjustment is a clear signal of market recalibration. It's moving from, let's say, pure exuberance to a more grounded yet still optimistic assessment. The initial surge in Xiaomi's stock price following the YU7 launch effectively priced in much of the immediate positive news and that first wave of high expectations.
Got it.
So, lowering the PS multiple implies that while the underlying growth story remains strong and shipment volumes are indeed increasing, the market is moving past the initial hype phase. Investors should interpret this as a more conservative yet fundamentally robust valuation approach. It signals that future upside may increasingly depend on concrete, consistent execution, sustained profitability, and continued innovation.
Rather than just potential.
Exactly. Rather than just the promise of high growth. It reflects a maturing market perception of Xiaomi's EV venture. It's no longer just a novel entrant. It's now a serious player that needs to consistently deliver results.
So wrapping this up, what does this all mean for you, the investor? BofA Securities' latest deep dive certainly reinforces Xiaomi's promising position. It's driven by that robust EV momentum and, perhaps critically, a remarkably strong balance sheet. It paints a picture of a company uniquely equipped, perhaps, to navigate a fiercely competitive landscape.
Which raises an important question for you to consider. As Xiaomi continues its ambitious push into electric vehicles, how will its truly integrated triathlon business model combining hardware, retail, internet services, How will that truly differentiate it? And how will it affect its long-term profitability compared to the pure-play EV manufacturers who lack that broader ecosystem? That integration is key.
It's definitely something to watch closely. We encourage you to delve deeper into these fascinating aspects. Thank you for joining us on this deep dive. We'll be back soon with another analysis of the sources shaping our world.